Hello, everyone. We are just beginning our webinar. We are letting everybody in, so just bear with us. My name is Jyoti Bisbee. I'm one of the executive committee members in WAP and the program leader for the Blended Finance for PPPs program. We have all our speakers ready, and just give us a minute so that the attendees are entering the waiting room, and as we are letting them in. We have a lot of interest for the local currency financing webinar. We have more than 200 registrants, so let's see how many actually attend this thing. We are going to make the video available after this session. So as you're joining, please feel free to introduce yourself in the chat, where you're joining from, what is your interest in local currency, whether you have interest in working or you are working on a PPP or a local currency financing deal. So keep it interactive so we all know each other. Obviously, all of us are all over the globe, so that's also very nice to see that we have such an interest from different countries. As you can see, the count is going up. I see some familiar names. I'm just so glad to see some of you are attending all of these blended finance sessions. We are planning to have a master class in the fall, October or November. So we are definitely going to really count on some of you who are attending all these blended finance. I hope that you're finding them useful. So also give us feedback in the chat. So we always want to hear from you. We have an excellent panel. So we're gonna give just 20 seconds more, and we're gonna join. I see Ziad and JC are here. If you want to elevate Aisha, Ziad, and JC so they can switch on their camera if they want, you can do that as well. I see lots of familiar names. Thank you for joining us again for this session. Hey, Charlie. All right, so I think with that, we have a good number as people are joining. We will keep interacting with you on the chat. So I'm going to start the session. Really welcome to you all. Good evening, good afternoon, and good morning, wherever you are from. And I think I will hand it over to my colleague, Jacques Follin, to open the session. Thank you so much.
Well, thank you very much, Jyoti. Well, good morning, good afternoon, and welcome to all distinguished delegates, esteemed colleagues, and participants. My name is Jacques Follin, a member of the Executive Committee and chair of the Airport Chapter of WAP, and I am delighted to open the session today. Let me start first with a warm welcome to our esteemed experts and panelists. As you said, we will have a wonderful team of panelists today, and to everyone joining us online for the fourth webinar in WAP's 2025 series on mobilizing blended finance for PPPs. I guess we had already 3 sessions. They have been very successful, and I want to thank Jyoti and her team for this work. Today, we will explore how blended finance can be structured to unlock private sector investment using local currency. As you know, local currency is crucial for PPP because it reduces foreign exchange risk, promotes domestic financial market development, and allows for more sustainable and long-term infrastructure projects by aligning financing with local revenue and needs. Many what we call low and middle income countries, particularly in sub-Saharan Africa, Central Asia, and I guess Southeast Asia as well, face the challenge of repaying loans in foreign currencies. With most of their debt in dollar or euros, strong currency, these nations are in difficult position. When their currency weakens, their debt burden goes up. The traditional reliance on foreign currency financing has exposed these countries to significant exchange rate volatility and worsened debt levels for countries that are already facing limited debt service capacity. So it's an issue. According to the International Debt Report, developing countries spent a record of 1.4 trillion. I don't know if this figure is exact, but it's a range, to service their foreign debt as their interest costs climbed to a 20-year high in 2023, with interest payment surging to a record of 406 billion, which is a huge amount for these countries. So local currency financing is therefore a pivotal tool for balancing the required in-country infrastructure spending and existing currency obligation. It has the potential to mitigate financial sustainability vulnerabilities and reduce the financial strain on developing economies, whilst advancing sustainable infrastructure and development goals. We are very happy at WAP of having a wonderful team of partnership associates with Mpumi, Ukamaka, Lilian. I don't know, they are all on the line. All this team is led by Jyoti. And thank you all, because they have prepared some insight on local currency financing for PPPs, which is in the chat. So I guess I encourage all of you to have a read through this. Jyoti, you can probably tell everybody if it's in the chat right now. To moderate such session, well, I would say that no one understands the challenges of local currency more than Prima Atugunza. We'll see her. She is a world champion in managing the local currency issue. And Prima shares the airport chapter of WAP and leads the PPP portfolio at ALSF, which is the African Legal Support Facility. Prima has a dual license, Ugandan and New York, as a Ugandan and New York lawyer, and she has 13 years of experience in energy and infrastructure PPPs. So I would say now the floor is yours, Prima. Thank you very much to everyone.
Thank you, Jacques. And I don't know if I'm a world champion, but maybe of understanding the challenges, because they are many where I practice. But thank you very much for that kind introduction. And good morning, good afternoon, good evening, everyone. Really excited to moderate our panel today. As introduced, my name is Prima Atugonza. I lead the Africa chapter of WAP. I also head up the PPP and infrastructure team at the African Legal Support Facility. So today I'm really honored to moderate this panel, because it's about a topic that we all know is very important, but it's very critical that we discuss local currency financing, because it's becoming more and more a solution that is something that's posed as a solution for the financing challenges that we have in emerging markets. So as Jacques has rightly pointed out, without local currency financing solutions in PPPs, developing countries will struggle, not just to achieve the sustainable development goals, but also to meet climate targets, to unlock sustainable economic growth. But I would say more importantly, to even simply increase the number of PPPs. We've seen that we've had PPPs, for example, on the African continent, talked about for a very long time, but we don't have a corresponding number of projects. And we now think that it's high time that local currency financing became a solution. We know, however, the challenges are many. In Africa, where I practice, some of the challenges are as a result of the fact that capital markets are really still developing. So then how do we access the local currency financing that we're talking about? We know that long-term financing solutions are limited. And many times, if you are to use if you're to use local currency, the interest rates are crazy. And we know that, of course, macroeconomic conditions can add to the cost and are a particular interest when it comes to emerging markets, particular interest for investors. So today we brought in a seasoned panel of experts. I'm very excited about this panel, because this panel represents the people that we think have the solutions. We have people from the commercial banks, we have people from the development finance institutions, and we also have people that have actually designed instruments that have been used for local currency financing. And lastly, we have a representative from an emerging market, and that is from the PPP unit of Egypt. And so this is the client that will be telling us whether all these proposed solutions can actually work for PPPs. So some housekeeping first. I'd like to, first of all, before we go to housekeeping, just to tell you the format of this webinar. We're going to have, each panelist is going to have about 10 minutes to present either the solution or present a case study where local currency financing has been used. And then we will also have a session by the PPP unit of Egypt to tell us whether this would actually work or if it has been used in Egypt, and we'll definitely have a Q&A session. Would like to keep it interactive, so please introduce yourself in the chat. Tell us where you're joining us from. The panelists we already know are joining us from everywhere. We have people from South Africa, from Egypt, from Nigeria, and people sitting in Belgrade because the UN ECE forum is going on now. So we really have a good presentation, and so would like to know where you're joining us from. I usually ramble a lot, so I'll stop. And we're going to start with our first panelist, who is Paul Harrocks. Paul Harrocks will set the stage by putting the local currency landscape into perspective. He's the head of the Private Finance for Sustainable Development Unit at the OECD, and he brings extensive international policy experience and is really a global voice in blended finance. He will discuss the OECD report and really highlight for us challenges and what they've seen are the challenges to local currency financing. Paul, welcome. And why don't you go ahead and tell us why securing currency financing is so difficult in emerging markets and what structural barriers must be overcome to scale it up. Over to you, Paul.
Thanks, Prima, and thanks to WAP for the invitation and for Jacques and Giotti for giving those nice introduction scene setting. So I'll try and fulfill what Prima set out. So I lead the Private Finance Sustainable Development Unit in the Development Cooperation Directorate in the OECD. So very nice to be with you and this afternoon and the morning and talk to you a bit about the report, Unlocking Local Currency in Emerging Markets and Developing Economies. What role can donors, development finance institutions, and multilateral development banks play? So just to say that, and if we can go to the next slide, I'm going to jump right into it and give you a bit of an overview of an example of a currency mismatch. So, but as we've heard, borrowing in hard currency leaves governments and businesses, very much exposed to exchange rate volatility, increased risk of default and during periods of local depreciation, and problematic for infrastructure projects which are burdened often by foreign debt but generate income in local currency. So access to local currency is essential, and that's why we did the report, and that's why I'm glad to see that WAP's raising this topic and having it as part of these discussions. So it's essential. Why? To create jobs. It's inclusive to economic development. And if we're going to deliver on sustainable transition and move towards the SDGs, we need PPPs, and we need PPPs that can be financially sustainable and that they can be linked with the local economy and local investors. So as we're seeing, PPPs are largely large-scale infrastructure projects, and on occasion you might need imported construction material that will need to result in continued access to hard funding in hard currency, but therefore the risks are borne by the local currency actors, and if you incur local currency depreciation, the cost of capital can also blow up, and this will often disencourage private investors from future transactions as well. So there is, if you've got a pipeline, it's much better to have stable financing and have it in local currency. So what we see here is just the balance sheet. So this could be the balance sheet of a PPP, special purpose vehicle, and what you will have is basically you've got a mismatch between what may be a DFI or an MDB or a donor that's providing. When you have your balance sheet exposed, you will often have to address that currency and take a hedge out. Now, those hedges can be very expensive. They can also be very short term, and often for large scale PPP projects, difficult to get. So that's and the bulk of MDB DFI financing remains in foreign currency. So the risk is imposed on the borrower, so not on the lender. So all this exposure to the variations of the US dollars and other currency movements are exposed to the PPP borrower. So we're trying to, with this report, look for solutions, options to increase and reduce this 90% to something lower, that would encourage local currency lending and local currency transactions, and not have this disparity where everything's done in USD or euros or other foreign currencies, which adds to the cost significantly of projects. If we can go to the next slide, please. So we've basically had a look at the challenges around this, and I mean, DFIs and MDBs, they very much guard their credit rating and their preservation of capital. So they have internal policies that dictate that they want to keep their lending in hard currency, and their risk appetite tends to be limited. So if we're going to move there needs to be better solutions to engaging and taking on local currency risk. So local currency guarantees, local currency first loss. All these can be part of the solution, but there's also regulatory. So for infrastructure projects, from comparing an OECD country to a transaction in sub-Saharan Africa, you've got to have a lot more of your capital preserved if you're investing in sub-Saharan Africa than compared to a project that sometimes might have the same risk in another developed or OECD member country. So there are some limits to this because of Basel III insolvency that's impacting institutional investors, and currency risk comes into that because the rating agencies, the banking regulators all put that as well onto the risk rating that they use to calculate risk parameters. There's also the incentives to, there's not sort of scalable instruments at the moment. There needs to be better dialogue with institutional investors, and their capacity is often to provide limited currency solutions. So they don't generally want to do transactions in local currency. And even we've seen some institutional investors, some banks in local developing countries that don't want to invest in activities and prefer to sort of buy US dollar sovereign issuances from their sovereign government than participate in the local market for financial transactions. So there is as well weak regulatory environments and enabling environments. So that's technical assistance, catalytic capital that needs to be used to help PPPs, help the pipeline, help ministries, debt management offices, treasuries, others have the capacity to work on domestic capital markets and work in the framework of PPP. So thinking a bit how they can use big pools of savings, which often are sometimes used for activities overseas when they should be in local currency in their own domestic markets. Next slide, please. So this is a bit of an overview of the concessional level as a percentage of the total project costs. So as you can see, local currency is like the biggest cost in terms of overall at 10%. So it's really important that we try and address this because it's adding so much to the cost of the capital stack. And scale remains constrained in many of the markets that we look at in sub-Saharan Africa by inefficient liquidity, currency-specific risks, but these can be addressed by donors supporting and taking more crowding in of the private sector with local currency financing actions. We have seen some models that work, TCX, Front Clear, that provides liquidity in secondary markets, and these provide hybrid public structure, private structures, and continue to receive donor support. So there are activities out there, and I encourage you to use them and test them on the context of PPPs and see if they work. Next slide, please. So in terms of sort of looking at trying to unlock some of the elements in the short term, well, we looked at these, and there needs to be a balance really between local currency and the currency solutions available. So it is complex. I mean, there is you can't do this in the short term. That you need to take into consideration the local financial system, and poorly planned, and it could destabilize and overwhelm local capital markets. And there is a bit of a balance between how much can I raise in my local financial system and how much do I need to raise overseas, in terms of balancing that if it's a very big project or if you've got lots of really big infrastructure projects. So the factors as such as the sort of country's foreign exchange reserve levels, import-export dependencies, the credit rating, amongst others, all come into the mix between local and hard currency needs. So making and adjusting and addressing that balancing is important. But so what I'm saying is that it's not a silver solution to sort of move everything to local currency. You've got to phase it and carefully implement it, sequence with your broader financial system, and requires similarly iterations and innovation. But you can unlock the potential of your local capital markets by essentially looking at the NDBs, and they have, as we've heard, as I've said, they need to structure transactions that are compatible. So they need to look at what's available, if there's a guarantee that can be worked in a particular country, how they can support local banks to encourage further local currency lending, and look at all the instruments that are sort of available. And there are quite a few that could be converted from hard currency now to local currency. As I've mentioned, the liquidity and sustainability facility could be better streamlined with donor resources and expanded and have enhanced market building efforts. So taking on a bit more of the market risk of currency as opposed to just the project risk. And then if I can just go to the next slide and just finalize now with the term of the long-term element. So we really need to have reform frameworks. So donors need and NDBs need to review and how they think about debt issuance and financing, really deepen those local capital markets. You should be prioritizing developing financial infrastructure and scalable instruments like bonds in local currency, do a gap analysis of the financial markets and look at concessionality levels and tailor those to the sort of offering in the market. So thinking a bit about lower concessionality or loans in more advanced markets and more mature markets, and then high levels of concessionality in those that are less mature, and sort of calibrating that to be coordinated and systemic. You need to have donors that are coordinated, so they need to organize regional initiatives, and that's critical in harmonizing regulatory standards and having robust frameworks to enhance and boost liquidity. But I'll share the report and the link, and I look forward to this discussion. And that's just a broad overview of the paper. It's got a lot more detail, but back to you, Prima, and thanks for the opportunity to present.
Thank you, Paul. And I know that 10 minutes are not enough to sort of even begin to scratch the surface. So thank you for at least just painting the picture for us and setting the scene for us. And I think what I could hear from you was that local currency currently is expensive. One of the biggest challenges to local currency is the fact that it's expensive. It's not incentivized in the way in which it is used. And so it is difficult to incorporate it in markets that are already experiencing fiscal challenges. And I also saw that you have thrown a lot of responsibility to Aaron and other DFIs in terms of the initiatives that they should be taking and the sort of instruments and the sort of leadership that they should be taking to begin to sort of make that turn to the use of local currency. And so at this particular point, it's my honor to welcome the next panelist, the next set of panelists. We will be starting with Arun Kumar, who is the Principal Investment Officer at the African Development Bank Group. Aaron is a certified investment and strategy professional with about 2 decades of experience in high impact investments worth multi-billions, primarily in emerging markets. Currently, he manages healthcare investments across Africa at the AFDB. Arun, I'll hand over to you, and please let us know what's the AFDB doing. What are you thinking of doing that can help us to better utilize local currencies within the big PPPs that we're trying to implement?
Thank you, Prima, and thank you, colleagues, for this opportunity. I think this is a very interesting topic. One of the challenge, I think, when we are looking at, I look after the healthcare investments and education investments across Africa. And one of the challenge, when we were looking at healthcare investments over a couple of years, we realized that, the healthcare is a very unique sector, which has, we have seen that COVID-19, which has exposed the healthcare infrastructure system in Africa. And we were looking at how we can support the private sector. I think that's the one way what we are looking at over a period of time now. The foreign aid has been reducing over a period of time. And now there are some of the new challenges and trend we are seeing on a capital side. I think there is a one way to boost the healthcare investment is local resource mobilization. I think that's where our efforts are. Today, I'm going to discuss about one of the projects in Africa. This project we have almost finalized. Now, this is a tertiary healthcare facility in Africa, which is about a project cost about $75 million. And when we were discussing this project with the private sector and the government, one of the challenges we found is that there was a risk, the risk which was not allocated or cannot be managed by any of the parties. If you look at some of the risk in terms of this project is a land equity. So it is coming from the government also in the private sector. There is an operator, which is a foreign operator, which is also coming and playing a role in terms of specialized services. But the biggest piece was the Forex. Now, who is going to take the Forex risk? And it's not easy to take the Forex risk for, let's say, for 7 to 10 years, because the feasibility of the project comes only if you're looking for a long-term capital structure, right? So the challenge was the government was it's shying away from any of the facility, because this is a PPP arrangement. So that means private sector has to design, develop, and finance and construct the project on their own capabilities. So when we were looking at this project, we were looking at how we can provide a long-term patient capital and at the same time reduce the cost of capital, because overall the IRR of the project in USD was 20-25%. But when we look at the cost in terms of the USD and the fluctuation of the currency, because please remember that the revenue is in local currency. So if we look at on an average, the African all the currencies on average, devaluation is about 10 to 15%, which is substantial, which can take away whole, profitability of the project. And without sustainability of the project, it is very difficult to come and have an impact on the society. Because as an African Development Bank, our objective is to ensure that the project is supporting the society, not only the private sector, but vulnerable part of the society, government. And the other part of the healthcare, if you look at, the healthcare spending on an average on the continent is about 1 to 2% if you look at a global terms. And the disease burden is about 17%. 17%. And I think the population is also, around that size. So the disease burden is a lot. The healthcare spending on the continent is very low. Now, the solution is only private sector. So when we discuss with some of the local players, local banks, we found out there is one way to look at is that if we can provide some sort of a partial credit guarantee or some innovative structure where the risk is transferred from the local banks to the DFI. And that's where we look at two options. One was the partial credit guarantee, where the AFDB will take the credit risk of the project, of that particular debt, and the project will not have any issues with the local bank. Now, then the question about is the liquidity, how you bring the liquidity to the project. Because $75 million project, any local bank can take about 10 to 15% of the, let's say 10 to $15 million on a single obligor. Then the second option we had was synthetic local currency loan, meaning that the bank will provide dollars. At the same time, we will manage through intermediary in a sense that local bank will play a role, but the risk is transferred to an international intermediary, which has expertise in terms of managing the forex and local currency. So the bank will charge a very minimum amount on that, but still there is a risk is transferred from the local institution or the sponsor to the international agency, which has expertise in managing. So when we look at the cost of capital in these two structures of partial credit guarantee and synthetic local currency, the project was very much feasible. And the interesting part was that the tenure of the loan is about 9 to 10 years, which makes the project feasible. And but still, I think the borrower holds the responsibility in terms of any fluctuation in terms of beyond a particular time. So there is a risk sharing between the private sector, the local bank, DFI, as well as the financial intermediary. So I think that's how we could able to structure the project, and the cost of capital is manageable, and that's where the project is showing sign of success at the moment. Thank you.
Sorry, thank you very much, Aaron. I think that's very helpful, and it really does paint a picture of the instruments that are being used right now by the bank, and that's the partial credit guarantee, as well as the synthetic local currency, where the bank is taking on the risk on behalf of the local bank, so that then you're able to actually use local currency. I'm going to move to Daniel Miller, who's also going to just explain and tell us the instruments that they're using at InfraCredit. Daniel Miller is an executive director and COO at InfraCredit Nigeria, which since 2017 has been pivotal in providing credit enhancement in support of the first local currency infrastructure and corporate green bonds in Nigeria, catalyzing over 300 billion naira in long-term local currency investments. Daniel has 25 years of transaction and infrastructure finance experience, including over 20 years in sub-Saharan Africa. Welcome, Daniel. Over to you to just let us know how you have been sort of promoting the use of local currency through InfraCredit. Over to you.
Thank you, Prima, and thank you, WAP, for organizing this event. Happy to be here. So I have a few slides I'll run through. So a bit about InfraCredit. So we've been operational since early 2017, set up by our Nigerian Sovereign Investment Authority, basically our sovereign wealth fund in Nigeria. We've added other shareholders, Africa Finance Corporation, Infraco Africa, basically on the back of about $200 million in paid-in capital. We issue credit enhancement to infrastructure projects here in Nigeria, facilitating access to long-term local currency debt finance. Over the last 8 years, we guaranteed the first 10-year corporate infrastructure bond in the market, the first 15-year, which also happened to be the first corporate green bond in Nigeria, and also the first 20-year corporate infrastructure bond. We're AAA rated by both of our major rating agencies here in Nigeria, and then we have our global rating from Fitch. Over time, we ultimately have actually exceeded the sovereign rating of Nigeria on the back of our track record. To understand our market, so Nigeria privatized the pension fund, the pension assets basically in 2004. So there were reforms that put the majority of pensions into private hands. This means we have at least 15% a year annual growth in assets under management by our Nigerian pension fund community. Today, they're holding over 23 trillion naira, which in dollar terms is about $15 billion. And of that, about 35% can actually be invested in corporate bonds. So that's really our target market, is guaranteeing 10, 15, and 20-year long-term local currency debt instruments, which pension funds are buying. These are registered with the Securities and Exchange Commission, publicly traded. And what does it give the borrowers? It basically gives them that tenor that they cannot get from any other source in terms of local currency. The commercial bank market may give you a 5-year loan. It's going to be a variable interest rate. They're going to adjust the rate based on market conditions from time to time. You could borrow maybe long-term from some international DFIs, but that's typically been in foreign currency. And the benefits have really been clear. Over 8 years, we've backed over 300 billion naira in local currency debt issuances. In terms of dollar value at financial close, that's about $275 to $280 million. Some of our early clients, and I'll go back to 2017, the first client that we backed raised about $27 million for off-grid electricity and natural gas projects. That was 10 billion naira in local currency. First 10-year corporate infrastructure bond. They were a first-time issuer in the Nigerian debt capital market. They part of that instrument, they had a 2-year principal moratorium to really allow them expand their asset base. And that, again, it gave them the tenor to give them the breathing room to really focus on their business. That 10 billion naira today, if somebody were to issue, it's basically the naira has lost 78% of its value in the last 8 years. So in terms of repaying that debt, as long as your infrastructure client, as long as that borrower is able to pass through the inflation impact, the devaluation impact to their end customers, which is typically what happens with infrastructure assets. Infrastructure is essential. So as we experience 20%, 30% inflation every year in our market, our infrastructure clients are passing that cost through to their end customers. The repayment of their debt is flat. It's fixed based on how they borrow. They borrowed at a higher interest rate, maybe than you would in foreign currency, 16% for our first client, as low as 10% for other clients. But the repayment of that debt is far easier. And that's been proven across our client base. We're up to 22 actually clients now, none of whom have defaulted on these guarantees over the last 8 years because the services they're providing are essential. I'll go to our portfolio a bit. I didn't want to list out all the clients because they're not all publicly traded instruments. We did in 2021 start doing blended finance transactions where we can guarantee local currency loans that are at concessionary rates in our markets. So some clients are issuing 10, 15, 20-year bonds to the pension community on the back of our guarantee. Others are borrowing 7-year concessionary rate loans from the Bank of Industry, which is a government-owned bank in Nigeria that is targeted at spurring industrial development, but they do not take credit risk, which is wise because government lending tends to not have the same repayment rates as commercial bank lending. So our biggest clients are in the logistics space, gas to power, which includes cooking gas, compressed natural gas, liquefied natural gas, pipe gas, on-grid power. Our client in 2019 that issued the first corporate green bond in our market is actually a hydropower plant. They run a 600 megawatt hydropower plant. They had borrowed in foreign currency before getting involved with InfraCredit. And by issuing that 15-year bond on the back of our guarantee, they're able to refinance all their foreign currency debt. And so the same thing, their debt has been flat. Their debt repayment is flat in local currency, but their revenue has been growing by 20 to 30% a year just from inflation without even having to expand beyond that. So the debt repayment has been proven to be far easier for these clients by borrowing long-term in local currency. You can see the credit ratings of our clients, anything from BB+ to A-. And this is really the sweet spot. We're helping clients that are maybe BBB-, BBB. They would not be able to issue a 10 or 15-year bond in the Nigerian market without some enhancement. So they're backed by InfraCredit, and they actually bring that bond to the market as a AAA rated, irrevocably, unconditionally guaranteed instrument. InfraCredit has been taking the full risk on our entire portfolio of clients. Over the last few years, we've been able to blend in some other capital to support renewable energy projects from international DFIs, where we take the senior secured position. The DFIs take another 7-year debt position at a concessionary rate. So that's another way we're able to blend finance solutions for certain high impact sectors. This is a schematic of how it works. Again, we issue the guarantee to the pension community and other bondholders. We have a security trustee that holds the security on our behalf. That actually enables us to risk share. We can have commercial banks lend alongside, and then we share security. There's typically a bond trustee or a note trustee. That's where the repayments are going to. And that trustee is the same party that can call our guarantee. And because our guarantee is unconditional and irrevocable, we're not able to, basically we say all defense is waived. That has given the Nigerian pension community the comfort to buy these bonds at a similar interest rate to what the federal government borrows at. If I go back to this page, you can see on the upper right, pension funds in Nigeria have been buying largely federal government of Nigeria securities. Corporate debt's only about 10%, and that has been growing on the back of our guarantees, as well as some infrastructure funds that have come into the market in the last few years. Again, these are local currency infrastructure funds. But the history was that pension funds would basically just buy government debt. They're very risk averse, and they need credit institutions to come in and enable the kind of tenor that the market needs. I'm going to switch to one other presentation because part of the theme today is actually PPPs. So we developed a product for to enable long-term debt issuance for public-private partnership projects. These are done under a design, build, finance, operate, and maintain structure. And what it's really done, we just actually issued our first guarantee. It just closed a few weeks ago. You can see that if you look in the press, you'll see a toll road project in Ekiti State, where the PPP concessionaire has been able to issue a 20-year debt instrument with a multiple-year principal moratorium. And that really means the state government is not the borrower. We have had states issue bonds in Nigeria since 1978. They have historically been backed by their share of the federal income in the country. So the default rates are not bad. Actually, there's never been a default on a state government bond issued in this manner. But the tenor was typically capped at 7 years. And the projects themselves are usually, it's usually been a struggle to see how well are those projects doing. If we can shift those projects to well-structured concessions, 30, 35-year concessions, where private companies operate those assets, it can be schools, hospitals, roads, any major infrastructure within any state, those concessionaires can issue the 20-year debt instrument to the pension community on the back of our guarantee. And that should be an example transaction, which should hopefully open up the public sector infrastructure market to this solution in Nigeria. That's our expectation. So the same way we unlocked companies to borrow 10, 15, 20 years, we believe that on the back of this guarantee that just closed in the last 30 days here, we should now have a model for state governments to work with concessionaires, work with best practice design and development, and have those concessionaires issue up to 20-year debt instruments, priced similar to a federal government bond. So if the federal government of Nigeria is borrowing at 21% interest rates today, well, then the pension funds are going to buy these bonds at 21.5%. The hope also for the annuity PPP product is that if we back the right projects, the project revenues themselves should enable repayment from the project, right? If you have private sector design, development, construction, operation. So this is something to prove over time. Transportation projects historically do not easily pay back their debt obligations. You usually need state support. Reason being that you're creating value along the infrastructure, the transportation corridor. But if you back something like an electricity project or a water project, certain school healthcare projects, my own view is that those will be financially viable on their own, especially in urban areas. And you'll find that you don't even need to rely upon the state's share of their federal income allocation. And again, benefits, and this is just for this product, but benefits generally, the infrastructure developers are getting access to unprecedented tenors in this market. It is enabling users to get access to anything electricity, water, better transportation, industrial development. For this product, it is taking the debt off the state government's books and pushing it to the private sector. And also for the guarantees we've been issued in the last several years, it's really enabling the pension community to get access to new asset classes that just did not exist before. So we believe through our intervention, we've really been able to deepen the Nigerian debt capital market, bring a lot of companies into the debt capital market for the first time that wouldn't have done so otherwise. And as far as the interest rate differential, yes, you're borrowing at maybe 10% higher interest rate than you would in foreign currency, but all of our clients have seen that that's immaterial compared to the savings they end up with by not having to repay, by not having to bear the FX risk, the foreign currency risk of having to repay these loans in foreign currency. So thank you very much.
Thank you very much, Daniel. That was very, very interesting. And I think one of the things that I've picked up from your presentation is the fact that you are one of the biggest problems with local currency is the fact that it's not only expensive, but it can only be for a short term, right? Because again, linked to how expensive it is, it's usually linked to a short term. And so it's very interesting to see that as InfraCredit, you are then providing solutions that allow for local currency financing to simply be longer term. Because if it's not the government that's playing this role, which means that it has to be very short term, and you're allowing for private companies to come and play this role, then you are allowing to, or you are addressing one of the challenges of a local currency financing, which is allowing it to be longer term. You're also providing an opportunity for institutional investors. Institutional investors, especially the social security funds, have a lot of local currency, and they are looking for ways to invest this money, but for secure ways. And if it can be backed by guarantees such as yours, then I think we are moving really in the right direction of using more and more local currency. At this point, our last case study will be presented by Sianda Mflatelwa. I have been struggling with the name, but I think I have tried Sianda. And Sianda is a senior investment banker at RMB who has spearheaded transformative infrastructure deals across Southern Africa, including the award-winning Beitbridge Border Post and large-scale renewable energy IPPs. Sianda, usually commercial banks are accused of being very expensive and not able to lend the income and the currency that they have to long-term PPP projects. So let's hear from you, Sianda. What's RMB doing? What creative solutions do you have to ensure that we have local currency financing playing within a large-scale and long-term big projects? Over to you, Sianda.
Okay, thank you very much. I'll just do a quick introduction to RMB and where we play, just because it may be relevant in terms of some questions that may arise later around where we can really make significant contributions in terms of local currency. But please, can you go to the next slide? So essentially, I mean, as most people will know around the table, RMB is the investment banking, corporate and investment banking division within the FirstRand Group. And we are a group that trades under multiple banners, and some may have seen our sister company, FNB, on certain places on the continent. And that's relevant because, as a bank, where we've got a full service banking license and where we are deposit taking, it is infinitely easier for us to provide local currency solutions to clients that are financing project finance and PPP transactions. Please, can you move to the next slide? I won't spend too much time on this, but essentially just to show the footprint of, as RMB, we are a sub-Saharan African bank, and we do have our flags planted on certain places on the continent. What's important about this slide is that certain areas where we've got full service banking services, our offering as an investment bank and as a commercial bank differs slightly in terms of what we're able to offer, particularly in the local currency market, from where we have either a rep office or we have a cross-border or limited banking license. And that becomes a little bit later, prevalent later when I show the case study of the projects that we've done. But essentially, I mean, I've heard my colleagues around the table talking a lot about the availability of local currency, the expense and the tenors that local currency come at. But I think the theme that we are starting to see, especially in our chosen markets, is that there is certainly a push towards more use of local currency. And there are solutions that are able to crowd in more local currency into these large infrastructure projects. And I think the next slide actually goes a little bit more into detail around that. So my colleagues around the table have talked a lot around the benefits of using local currency and being able to do that. The obvious one being obviously to mitigate a lot of the currency mismatch, particularly where you've got local currency revenues within the project where it is user pay or where there's market risk. This becomes a lot more prevalent. And we see this as an element that actually safeguards and makes the project more sustainable, the ability to use local funding. As you can imagine, even from a political perspective, with long tenor financing, you always are concerned that the user pay model and the market risk model is susceptible to changes in sentiment, changes in macroeconomic environments within the country. And so the natural hedge that comes from a local currency tranche or a local currency funding package actually helps the project to remain sustainable. We also see the impact to the fiscus as something that is a key consideration and one that we think is a benefit to infrastructure projects. Because often in these large infrastructure projects, the termination regime has got line of sight or some form of underpin from the fiscus itself. Although these guarantees or letters of support or contingent liabilities are contingent on the fiscus, most times it does run a larger currency mismatch and a larger burden on the fiscus where there is a currency mismatch and hard currency is being used on the projects themselves, which is one of the other benefits. But by far the biggest benefit in terms of trying to crowd in local currency funding is to try and optimize the funding package. And that obviously depends on the cost at which you're able to get the local currency funding, whether or not you're able to blend it to create a seamless funding package within the project, whether you can call on different types of lenders, so commercial lenders versus DFI lenders, to provide the funding package within a project. And obviously there are other considerations as to the availability of local currency, but overall, the optimization of the cost of the infrastructure ultimately is a key determinant as to whether or not it is even feasible to use local currency within projects. Please move to the next slide. So, I mean, something that I want to bring to the attention is a comparison that we've done in, a lot of the markets that we are seeing in the SADC region. I'll highlight the transactions that we've closed recently with BPC in Botswana. Both happen to be in Botswana, but we have seen similar trends playing out in the Namibian market as well. And we are seeing a lot more demand for local currency within other markets where we have a full service kind of deposit-taking banking franchise. What's key to highlight about these projects, and I'll contrast it to the Beitbridge Border Post project, which is, follows a very typical infrastructure project on the rest of the continent, where a lot of the concerns and or macroeconomic elements that we normally see within projects of this nature were prevalent, and thus resulted in an all hard currency funding package. This is in contrast to the Madinare project and the Selebepikwe project. Both are 50 megawatt solar PV projects. So tick the sustainability and renewable angle in terms of projects on the continent. They both have long tenor PPAs, but interestingly, because of the way that those PPAs were structured, we were able to then have a substantial tranche within the projects that was local currency. There are some key enablers that allowed us to do so. And I'll talk about that a little bit more on the next slide. But what's key to note here is that, the mix of funding sources from both commercial banks and from DFI banks or DFI lenders can sometimes create a seamless funding package within a project where you're able to draw on the strengths of both types of lenders. So typically, DFI lenders do have access to longer tenor hard currency funding. They're able to provide these more cheaply and more seamlessly to projects, which create efficiencies within projects. So the challenge to us then with these two projects was to create a local currency tranche that matched or bettered the position that would otherwise have been prevalent if an all hard currency funding package was put in place. For these projects, we were able to not only have a significant match in terms of the tenor, so we were able to also provide a substantial size of tranche, but also the pricing of the tranches was comparable to the hard currency tranches within the projects. And because the tranches both ranked pari passu and were sharing in all of the project security kind of on an equal basis, it was important that these tranches kind of looked and felt similar in terms of the construct within the project, so as not to create an undue kind of risk between the two financing entities within the project as well. And so some of some of the things that allowed us to be able to provide this financing, I'll talk about in a little bit more detail. But I think one of the key messages from this slide is just to show that in contrast to the border post that we closed in 2020 or 2021, the later projects that we are looking at, we are really looking at with the eye of how much local currency can we put in, and is it possible to arrange long tenor local currency tranches. The tranches that we talk about here, the Botswana Pula tranches that we put into both projects were actually 18-year door-to-door tranche debt, which is quite comparable to, I think, the hard currency tranche that stood next to it was only 1 year extra in terms of tenor from a door-to-door perspective. Both tranches had the typical project financing structure where you had, capital moratoriums during the construction phase, and then, amortizing repayments during the operations phase. And so, and were drawn pari passu within construction, etc. And so the funding package actually, and after a lot of structuring to get it that way, ended up being seamless and efficient in terms of the project, and still delivered power at a tariff that was affordable to the state utility, which is obviously a key determinant to any procuring entity looking at these projects. Please, can you move to the next slide? So I think important to talk a little bit around some of the characteristics and some of the considerations that we also encountered in closing these deals. I'll focus more on the hard currency, on the local currency considerations and characteristics, just because the hard currency ones, by contrast, have been seen in multiple projects and are well understood. So one of the key determinants that allowed us to put a local currency tranche is obviously the revenue line. The revenue line really does drive the ability to add financing to a project. And because the revenue line was all in Pula, it really enabled for a large local currency tranche in the two projects that we talked about earlier. The interesting thing about this tariff in particular was that there was an interesting inflation indexation mechanism where it was partially indexed to US dollars and then partially indexed to local currency CPI. And that in itself created the ability to then have both types of funding, so both local currency and hard currency. But I would argue that had it been a fully local CPI indexation tariff, we could have used a much larger Botswana Pula and arguably maybe a full Botswana Pula tranche to fund the projects. So it's something that is key for procuring entities to think about in structuring PPAs and in the way that they structure kind of the main document, the concession agreement, the PPP agreement, or the PPA, in that the revenue line does really drive the ability for local banks, all else equal, to actually put local currency tranches within infrastructure projects. It also drives the tenor with which we can lend these projects. Because typically, where my colleagues have talked about, shorter tenor, it's mainly to fund the capex within projects, which happens early on in the project and very little in the latter part of the project. One of the other key determinants.
And you're muted. You're muted. I think we'll maybe just begin to conclude. But please come back on. Yeah.
Apologies. So I think one of the things that was interesting with this transaction is that some of the considerations that we actually grappled with whilst we were putting this funding in place was the depth of the hedging products, because I think what people don't realize is the use of local currency doesn't completely eliminate the FX risk. So we found that because a lot of the equipment and the EPC costs were actually still denominated in hard currency, the project did require hard currency within the project, within the construction program. And whilst we tried to implement as much of a matching as possible with the hard currency tranche, we did find that there was still a need to hedge a small portion of the Pula effects in order to convert it into hard currency for those large, chunky EPC payments that happen in the construction project. And then the depth of the FX market becomes very important, and the ability to find cheap FX hedges for the duration of the construction period becomes a key consideration. The other thing that we grappled with was then providing 18-year tenor local currency Pula within these projects. We found that the ability to hedge the interest rate long term was also extremely challenging. In some instances, you find that the market doesn't actually allow for long tenor hedges at all, and in some instances, you find that it's prohibitively expensive to put long tenor hedges. And of course, senior lenders within these projects tend to want to have more certainty of cash flows and to hedge out, big swings in interest rates. And depending on where you go on the continent, you may this problem may be more or less pronounced. And so what we ended up doing was putting in hedges for a rolling period with the ability to then extend hedges as we move further into the operations period. And so the hedging regime of the project itself had to be quite dynamic. And we had to do multiple tests to see at which point the project comes under serious financial stress as a result of changes in interest rates, and try to hedge such that we're sufficiently covered for what we see coming, and we have the ability then to assess the project as it goes along, and implement additional hedges should we do so. The one thing I think that is important to note is also that, in a lot of markets that we do business, the depth of the derivatives market sometimes is quite shallow, and the availability of derivatives that are quite typical for these projects sometimes is quite thin. And so the more local currency transactions that are actually implemented within these current countries actually does catalyze and spur on and increase the liquidity and the depth of those markets in and of itself as well. And so even having this dynamic hedging regime that we implemented within the project, our hope is certainly that the next project and the next projects that we see, we do find a lot more liquidity to be able to hedge local currency, and products available that allow lenders within projects to mitigate some of these financial risks that we see within projects, because it makes the project a lot more investable, and it makes the funding package a lot more sustainable. I think I'll pause there, and because I think the hard currency implications and the reason why hard currency is used, while depicted on the slide, is quite well understood and has been the way that business has been done on the continent for for longer than what we've been implementing local currency tranches in earnest. And so for us, I think we're excited to see that we do have an ability to do large, chunky local currency tranches within infrastructure projects to service the clients, but also to provide the infrastructure at a cost that is sustainable and affordable for procuring entities, but ultimately for the ultimate user as well. Thank you, everyone. I think I'll pause there.
Thank you very much, Sianda. And I think I am learning a lot personally, simply because when you begin all these terms, sometimes lawyers, we just run crazy, but I think you've been able to make it very palatable and very understandable in terms of what are you looking for. And I think the thing that I have heard from your presentation is the fact that even when we're talking about, number one, local currency is not going to eliminate the foreign exchange problem. And I think that has come straight from the beginning, where we've just been talking about the fact that local currency is just a player within the entire financing package. And so you have to find ways in which to make it work, but it's not sort of a magic wand that's going to come and completely do away with all the problems that are being caused by foreign exchange risk. I think you've also mentioned the fact that we need to think about which projects, we need to think about the term of which projects, and we need to very seriously consider both how indexing is incorporated within the entire project structure, but also how those revenue streams are working, because that is the most important consideration for commercial banks, if I had right. At this point, I am going to invite Atta, who is the head of the PPP unit of Egypt. Atta is going to be the judge of all the products that have been shared today. So he's going to judge Sianda, Aaron, he's going to judge InfraCredit, whether all these instruments that are being talked about are actually practical. Are they able to be used within the PPP projects? Because I think Egypt is really doing well when it comes to PPPs on the continent. So Atta, over to you. Please let us know what can local currency do within these transactions? What have you done in Egypt? What works? And are the financials today actually making sense? Over to you, Atta.
Thank you. Actually, there's too much on the plate to digest on this session. Too much experience and solution. Thank you for that. I would like to start this way. I'll give you the situation in Egypt and all the challenges that we've dealt with or we've met over the last 15 years, and different situation which we have to mitigate or to deal with and then we'll see which solutions can fit better with our situation. I want to skip all this kind of financial risks because it's already discussed and dealt with. The only thing that I want to highlight here is that when the risk is unquantifiable, it turns to be a deal breaker. And accordingly, most of the projects in this case, or the project that's suffering from this, would turn to be unbankable, and we don't have a project by the day. The local currency issue used to be a challenge throughout the 18 years that I worked in Egypt here in the PPP unit, and while I was working with the World Bank or the IFC and the other before that. I want to tell you that financing, I want to capitalize on Sianda's presentation, because actually there is no single local currency financing for a project. There should be, or there is, in practice, there is a foreign currency portion of this financing. But let me, in the ideal case, when we have an entire financing of a local currency, and the payment, in case the government is the off-taker, for instance, the payment would be in the local currency, and this is the optimal ideal solution. We've dealt with this actually in the first few projects from 2006 till 2011, where we had a very stable FX rate. Variance was very limited, and there was a high availability of the hard currency, euros and dollars at that time. So in such case, we used to ask the bidders to get the financing from and the blending financing from dollars and hard currency and local currency the way that they would find it better for them and for the project to be able to compete. And we were paying the government for the were paying against the service in the local currency. So in this projects, things was going perfectly fine and everything was stable. By that time as well, when you have an almost stable FX rate and availability of hard currency, you normally find that the interest rate for the local currency is not that high, not that expensive. Definitely, it's higher than the dollars or euros, but it's not that high as we are suffering it these days. So this was the few years of utopia, let me say, and then we suffered from a revolution in 2011 and another revolution, and then devaluation of the currency, and then the pandemic and all this kind of disasters that we faced. But let me classify the problems that we faced in different phases over this 10, 15 years, where we had the currency available and the FX rate is almost stable. And the second case was the availability of hard currency in the market, so you can get it easily. But the FX rate is unstable because there is some kind of heavy devaluation of the currency. And the worst scenario was the inavailability or a shortage of the hard currency and FX rate very unstable due to the local devaluation of the currency. Actually, in the from 2019 till 2023, let me say, this 4 years where the pandemic was there, we were suffering from shortage of hard currency, and devaluation took place starting 2017, then again in 2019, 21, and 23 and 24. We've got a lot of devaluation. As we all know that there's no one size that fits all, so we have to change our mechanisms and the risk mitigation tools to make the project bankable and to have the private sector still interested, and the most important, to have the banks available. By that time, when we have the hard currency shortage and the local currency devaluation, which was the case in this period from 19 to 23, 24, there was a high risk at the private sector in securing hard currency to import the technology or the electromechanicals or the equipment that they need, because it's not available in the local market. And this second, on the other hand, the government or the payers, which is the government in this case, most of the offtakes, are need to be paying in dollars, because the private sector wants to pay back to the banks in dollars, and the dollars are unavailable or there is some kind of shortage. And when I say hard currency shortage, this means that there is another price in the parallel market, and this is another problem. So this is a kind of risk that the private sector cannot tolerate. The devaluation of currencies every few years, 2 or 3 years, and unavailability of the dollars or the euros, and the banks wants to lend in dollars and they want to be paid back in dollars. So this is the main problems. In this awkward situation, we usually find that there is no hedging tools available, or the hedging for the Egyptian pounds or for the local currency against dollars would be something like we've seen only 3 months. You cannot hedge more than 3 months. So actually, there is no hedging tools. Local banks refuse to lend in dollars unless the revenues are in dollars. So this means that the government, in this case, has to pay by a portion, at least in dollars.
Khater,
And
I'm so sorry to interrupt, but people are asking, the slides are not moving. Do you want me to share my screen?
oh, I'm not moving. It's moving
Yeah.
at my side. I don't know. I'll stop sharing and you can use it, please.
All right, thank you. I will share my screen and you can tell me which slide you want to project.
I'm sorry, I thought it's working.
So is this slide okay?
Uh,
Or go back?
yes, please. One back.
All right, thank you.
Okay, I'm sorry for that, but I thought it was working because it was working at my side. Oh, so when I was just saying that in this situation, this is the worst situation that you can face. And this we faced this for a few years. And we have a lot of projects to tender out for the PP, for the private sector, and that we have to depend on the banks on financing this project, which is the hard currency shortage and the devaluation of the. And as I just mentioned, in these cases we have to know that there is a parallel market. So if the $1 is against 30 Egyptian pounds, you'll find it in the parallel market for 45 and sometimes 50 pounds, which is almost double. This is another high risk. In these cases, there's only two solutions. The government have to pay the availability payment or the payment against service portion of it in Egyptian pounds. And actually, we structured that and we tendered some of the project in this. So, in Egyptian pounds and the rest, another portion in US dollars. And in this case, we have to pay in dollars. So, for instance, if it's 40% of the availability payment or the cost of the service in is 50 pounds or 10 pounds and 5 cents, we have to pay it in 5 cents and 10 pounds. Okay, the portion, the foreign currency portion, have to be paid in foreign currency. So this was this period. There was another solution here because we don't want to have the market, the government exposed to that high risk, because in this case the government is taking the FX risk and the availability of dollars risk, because the private sector will not take at this situation. So during the evaluation of the bids, we've put two things. Number one, based on our studies with our advisors and the financial model that we do internally here, we put a cap for the foreign currency portion of the capex. The other thing, there is in the evaluation, there is some additional points for the less dollar components. So the least dollar components will have much more better opportunity to get this to get awarded.
I'm afraid I'm going to just have to ask you to just wrap up. No, keep going, but just to wrap up. So yes.
All right. So this was taken in consideration, a cap, and in the evaluation we put some additional points so we can decrease the exposure of the government on this risk. We used another solution, which is the blended financing. In such cases, we ask the private sector to finance the local portion of the project. And the government takes through soft loans from the MDBs and finance the hard currency portion. So this was another solution that we've used in two projects in this period. The case have been changed in the last 2 years. And can I have the next slide, please? On the last slide. The situation have been changed. We don't have anymore this shortage in the currency. The currency is available. The banks can secure this currency one way or another. Okay, and still there is a very high risk or expectations from the private sector that still devaluation might take place, and the FX risk is the foreign exchange rate is still unstable. So in this case, we've changed the mechanism. So to let them available for them to borrow in US dollars to enjoy the uh, low rate of interest rate, because by that time, as we're talking now, the interest rate in Egypt for the local currency is approaching 30%, which is very, very high. And actually, yesterday it was dropped to 25%, and it was in the tending to go down, but it's still very high against the 5% or 6% for dollars. So we encourage them, if you want to get your dollars, get it. But and your pricing, the pricing will be portion in dollars and portion Egyptian pounds, and this dollars will be paid in Egyptian dollars. Paid in Egyptian pounds, as per the interest, the FX rate of the day of payment. Okay, so this was another solution. Actually, we've got 7 projects now in different phases of procurement, and we found a lot of acceptance from the private sector and the banks to this solution, given the situation. But we have to put in the contract that if the situation moved back and there is a parallel market with a very high price and there is a real shortage in the banks, then we have to put some kind of mitigation, because this project is 25 years or 20 years. And actually, the situation which was very bad 2 years or 3 years back, it's now very good or much more better. And things might change because due to the geopolitical issues. So this was the kinds of mitigation that we've done to overcome our challenges that we faced in different aspects. And actually, it's working. It's worked, and it's working now as well. But I've heard today a lot of other solutions that I want to receive. How can things fit with our current situation, especially the second and the third phases that I've just mentioned, when we have no dollars or shortage of dollars and devaluations, and in case that we have dollars, but still there is a foreign exchange risk. The last thing to say is that currently, as we just said, that we've got 7 projects down on the procurement. Actually, I have to mention that these days, after the central bank 2 years ago just liberated the FX rate, the black market or the parallel market disappeared completely, and we have a stable one single currency. As any bank, you can just go in and buy some dollars or whatever, but still there is a threat at the banks and at the private sector that this rate might change at any time or be much more. Sorry for being a little bit long, and thank you very much.
Thank you very much, Atan. I think that's been extremely practical, just like the other presentations, to sort of bring it home. I like the fact that Egypt is sort of addressing the local currency situation throughout the life cycle of the project. I'm sure in the way in which you select the project, but during the evaluation as well, the way that you evaluate favors local currency financing, but also ensuring that you have a good mix of both local currency and also beginning to index sort of whichever hard currency are being whatever hard currency is being payment that's being made to index that as well to the local currency. And so those are solutions. Interestingly, I thought that you would be a judge of the other presentations, but you've taken more interest and would like to now be a client. So I'm sure you'll be speaking to Daniel, Sianda, and Arun after this to sort of take the conversation forward. And that's the purpose of WAP, to sort of create the platform. Unfortunately, we do not have enough time for questions. Aaron and Daniel, there were some questions for you in the chat about whether the concession agreement, Aaron, you discussed whether that's based on availability payments, and for Daniel, whether all the bonds were private placements. So I'll just ask you to maybe quickly respond in the chat. Because we would like to finish on time, but thank you very much. I think we have gotten very, very practical insights, and I'll hand back over to you, Jacques, to just sort of close it all up together for us to sort of understand what has been discussed today. Thank you very much. Over to you, Jacques.
Well, thank you, Prima. But just first thing I would like is to thank our experts. They have been great. We had a lot of presentation, I mean, showing the interest of having local currency financing, how to mitigate the risk of having local currency financing, how to find solution to blend financing, how to offer guarantees in order to secure longer maturity for local financing. So it was very interesting. I think we could speak during many hours about this local currency issue versus hard currency issue. So, well, I want to thank everybody. Say that this webinar will be available. The recording will be available on the WhatsApp channel, on the WhatsApp channel. I'm sorry, and so I hope that you will be all attending the next webinar on blended finance, which is planned in June. I don't remember the date, but I mean
June 19th.
On the 19th of June. And so thank you to everybody. Thank you, Jyoti. Thank you, Prima. Thank you, all our experts and all the people that have been attending in this wonderful time together. Thank you.
Jacques, I think Ziad has something to say, and when the president has something to say, who are we? Over to you, Ziad. Please, you may conclude.
Thank you, Prima. You're very kind. And I just wanted to say that basically share a little bit, very briefly, of my 30-year experience in this field. Just to say that loved everything that I've heard. Fantastic speakers today. Thank you very much. Great ideas. I'd like to just say that what is the common thread between everything we are hearing today and everything we have seen in this field of dealing with local currency risk? It is really spreading the risk. The key element is spreading the risk, is finding how that risk can be shared between all the players, all the stakeholders. It could be shared between the local bank and an MDB, or with the company of the project itself, or with the government, especially if there's a government fund. It can be shared with insurance companies or pension funds. It can be shared by entities providing guarantees like infra credit. It can be shared by the banks themselves by syndicating, so that one bank doesn't need to take on all the risk by itself. And if everybody, it's really at the end of the day, for PPP to succeed with local currency financing, it's a matter of, it takes a village. So everybody in a project, if everybody takes a little bit of the risk, at the end of the day, we can have successful projects. Thank you very much. That's all I had to say, and sorry to interrupt after the ending.
No problem. Thank you so much, everyone. I think the link, the date has been shared for the next webinar. That's June 19th. So see you on June 19th, and thank you everyone for attending. Have a good one. Bye.
Thank you very much.
Thank you.
Thank you, Jyoti.
Bye.
Bye.
Bye.